Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Thursday, March 19th, 2026, and we've got a fresh batch of AI-generated insights to unpack from yesterday's market activity.
That's right, Ethan. Our systems crunched through a few hundred posts across multiple platforms yesterday, flagging about 11 different stocks. The sentiment is, shall we say, quite a mixed bag today. Some highly optimistic outlooks, but also some significant cautionary flags to discuss.
Absolutely. So let's dive right in. First up today, we're looking at Dollar General, ticker DG. Now this one's showing some real resilience in the data. While some users were speculating about puts, the overwhelming sentiment, especially in the highly upvoted comments, is that DG is actually a defensive play. People are saying it thrives in tough economies. It's where everyone can afford to shop. Plus, we're seeing strong insider buying, almost 194,000 shares purchased in the last 6 months. That's a huge vote of confidence.
Well, Ethan, while I appreciate the optimism and the insider buying is certainly a positive signal, we can't ignore some of the KPIs. DG has a remarkably low beta of 0.22, confirming its defensive nature. But let's talk about the debt-to-equity ratio. It's at a very high 184.67. That's a significant amount of leverage, which could be a concern if interest rates continue to climb, or if their already thin net profit margin of 3.54% gets squeezed further by fuel costs, as some users pointed out. We also noted their EPS is slightly below management's guidance. Fair points, Brooke, but the analyst sentiment is strong too. Argus just boosted their price target to 165 with a buy rating. And serving underserved populations is a pretty stable business model. Considering all that and the strong insider confidence, I think DG looks like a buy. Next up, let's talk about SanDisk, or SNDK. Ethan, there's some wild community optimism around this one, with shouts of SNDK to $1,000 and comparisons to the 1999 dot-com bubble. Users are celebrating an amazing run from around $29 to over $750. It's true, Brooke. The energy around SNDK is palpable. News mentions big money buys and even talks about it becoming a $1 trillion stock. The revenue growth is strong at over 61%, and the operating margin is a healthy 35.5%. People who sold too early are regretting it, and those holding are very happy. It's definitely on a parabolic run, indicating massive growth potential, much like we've seen in the AI sector. I hear you, but the KPIs are flashing some serious red. Despite the impressive run in revenue growth, SNDK is currently unprofitable, with a net profit margin of negative 11.66% and an EPS of negative $7.46. That's a huge red flag for a company trading near its 52-week high of $761. Also, the debt-to-equity ratio is a very high 7.96, and the price-to-book ratio is an eye-watering 10.92, suggesting extreme overvaluation relative to its assets. We've actually rated SNDK as stay away multiple times recently, even after some buy ratings in between. Without a clear path to profitability, this kind of valuation is hard to justify fundamentally. For SNDK, it's a definite stay away for now.
All right, moving on to something with a very clear catalyst, Cheniere Energy, ticker LNG. Brooke, the data on this one is overwhelmingly bullish. The news of Qatar's Ras Laffan LNG plant being hit by a missile, that's a fifth of global supply potentially disrupted. Users are anticipating a massive surge in global LNG prices, and LNG, with its existing export capacity, is perfectly positioned to capitalize. It's already hit an all-time high. We're seeing huge insider buying, over 100,000 shares purchased in the last 6 months. Ethan, the geopolitical event is indeed a significant catalyst, and I agree, the operating margin of nearly 76% is exceptional, meaning higher prices will translate directly to huge profits. That's a very attractive KPI. However, we also have to acknowledge the debt-to-equity ratio, which is very high at 202.22. While increased profitability can help manage that, it still represents a substantial financial risk, especially given the inherent volatility of the energy sector and ongoing geopolitical instability. It's not without its challenges. While the debt is high, the immediate impact of this supply shock, combined with LNG's operational efficiency and insider confidence, makes it a prime candidate to generate significant revenue and profit growth. This is a very compelling opportunity in the current market. I'd classify LNG as a buy. Lastly, let's turn our attention to Micron Technology, ticker MU.
Now, the community sentiment is a mixed bag here. We've seen incredible gains, with users reporting 7-bagger returns and record AI-driven results, but there's also a strong undercurrent of caution, especially around holding through earnings. That's the story of MU, isn't it? Users are celebrating going from 20K to 75K in 4 days. That's some serious momentum. The RAM shortage narrative is strong, and news of sales nearly tripling and blowout earnings due to AI demand is absolutely fueling this. The revenue growth is fantastic at 56.7%, and the net profit margin is a healthy 28%. Plus, insiders have purchased over 880,000 shares, a 28% increase in their holdings. That's a huge signal of long-term belief. I can't argue with the fundamental growth, Ethan. Those numbers are strong. However, MU's price-to-earnings ratio is currently at 43.85, and it's trading very close to its 52-week high of 471. User comments are rife with warnings about buy the rumor, sell the news around earnings, suggesting much of that growth is already priced in. And the elephant in the room? An extremely high debt-to-equity ratio of 21.244. While strong earnings can help manage that, it's a substantial long-term risk that can't be ignored. Given the strong fundamentals, but also the valuation and debt concerns, MU would be a cautious buy. Investigate as buy. Dollar General Corporation, DG. Cheniere Energy, Inc., LNG. Investigate as cautious buy. Micron Technology, Inc., MU. Investigate as speculative gamble. SanDisk Corporation, SNDK. And that wraps up another insightful episode of the Daily Hunt for Multibaggers. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in, everyone. We'll catch you tomorrow for more Hunt.